Welcome back to Investing Talk Podcast. Today, we're focusing our analysis on a company that's really seen a dramatic strategic shift lately, NUAI, New Era Energy and Digital. And the big question we're tackling, the one traders seem to be asking, is NUAI, New Era Energy and Digital, a good time to buy now? It's an interesting one. Trying to bridge, early stage energy with this huge demand for digital infrastructure definitely puts it in that high risk, high reward space. We've gathered recent catalyst reviews, stock analysis, technicals, trying to give you the full picture. The potential upside, but also, importantly, the financial warnings. Our mission here is really to pull out the crucial bits from these sources so you can understand the stakes with this small cap player. And as always, please do subscribe, like, and comment. We build these analyses for you. And if there's a specific company you want us to look into next time, definitely leave a comment below and let us know. Okay, let's unpack this company's sudden strategic shift, shall we? Because this wasn't just a small tweak.
No, not at all. It was a complete U-turn on capital structure, and that's really what the market's reacting to. The key takeaway from the Catalyst review is this aggressive move toward disciplined capital management. They're basically signaling, hey, we plan to fund growth through operations or, other ways that don't dilute shareholders, taking massive dilution off the table.
Right. Sounds good. Disciplined capital management.
Yeah.
But what did they actually do in October? What were the concrete actions that made the market believe this?
Well, there were two main things, both pretty significant. First, in October 2025, they terminated their equity purchase facility agreement, the EPFA.
Okay, the EPFA. Remind us what that is.
Sure. It's basically a deal letting the companies sell shares, usually at a discount, to get quick cash. It's a backstop, but always means dilution. They canceled this agreement, which was supposed to run until the end of 2025. Suggests they don't feel they need that safety net anymore.
Okay, interesting. What was the second thing?
The second one was, frankly, kind of staggering. They withdrew their preliminary proxy statement. Now, this statement, filed just a month before in September, had outlined plans to boost authorized shares from 250 million up to 3 billion.
3 billion.
Yeah. And it also mentioned a possible reverse stock split. So major potential changes.
Well, let's pause on that timing, because September, when that proxy hit, that must have caused some serious concern, right? A potential 30-fold increase in shares. Dilution seemed baked in.
Absolutely. Investors saw that and understandably thought massive dilution was coming down the pike.
So fast forward just a few weeks, and they pull the plug on the financing facility and the giant share increase plan. Okay, here's my question, though. How do we know this is strength? I mean, couldn't it be necessity? Maybe they couldn't even use the EPFA anymore? Maybe collateral ran out or something?
That's a fair question and a crucial one. If they'd only terminated the EPFA, yeah, skepticism would be warranted. You could argue desperation. But they also withdrew the entire proxy statement, the one that would have allowed that huge share increase down the road. If they were truly desperate for future funding options, you'd think they'd keep that 3 billion share authorization alive, wouldn't you?
Good point. Keep the option open.
Exactly. So canceling both the immediate financing tool and the massive future authorization, well, it strongly implies a strategic shift. It suggests confidence in near-term organic growth or maybe other non-dilutive funding is lined up.
Confidence in their core operations, maybe, which is still that Texas digital infrastructure project, right?
Right.
What exactly are they building there?
That's right. They're focused on the next phase of powered land and integrated power assets, specifically for data center clients. Think of it as behind-the-meter power solutions. They generate the electricity right there on site for the data center.
Ah, so the data center bypasses the main grid.
Pretty much. That vertical integration is really attractive for huge energy users like hyperscalers. They want stability, predictable costs. So yeah, if we connect this operational focus back to the capital moves, it suggests management felt confident enough about the Texas pipeline to ditch the dilution risk, signaling that hopefully future revenues will cover their capital needs.
Okay, that strategic shift paints a much rosier picture, definitely. But we have to look at the fundamentals, too. The sources are clear. This is still an early-stage company, and the numbers reflect that. Heavy development costs, right?
Correct. When you look at the raw figures, you see those costs clearly. Trailing 12 months revenue is just $718,761. And with all the investment in building assets, the TTM net income is negative, about minus $18.76 million.
Which is expected when you're building big things, but confirms they're burning cash.
Exactly. It's expected, but it's reality. They are currently cash flow negative. The market sees them as a small cap, high growth potential play, market cap around $129 million. And importantly, a pretty tight share count still, just 28.43 million shares.
And that low share count is why those dilution talks were so sensitive.
Precisely. Any dilution hits harder with fewer shares outstanding.
But the buzz isn't just about the digital pivot. It's also about the resources they already control, isn't it? They've got traditional assets, too.
Yes, that's a key part of the story. They control a lot of land in southeast New Mexico, about 137,000 acres in the Pecos Slope field.
That's huge for a company this size.
It is. And what they're doing there is interesting. They're focused on a niche commodity, helium production.
Helium, not just oil and gas.
Right. And helium is fundamentally different. It's supply constrained globally. Applications are growing in tech, medicine.
So that gives them an edge.
It's potentially a significant competitive edge.
Yeah.
That helium optionality could be the thing that validates a long-term speculative hold because supply is tight and a lot of it comes from places with geopolitical risk. Having reliable U.S.-based production, that could mean real pricing power, much better margins than typical energy production.
So it kind of de-risks the digital side a bit,
Yeah.
having this other resource base.
It offers diversification and potential cash flow, yes. Mitigates some of that risk of being just a pure play, cash-burning digital developer.
Okay, but this brings us to the big but, the financial elephant in the room. The sources flag something pretty serious here, something that needs maximum caution from you, the listener. It potentially shifts the risk profile significantly.
That's right. And it's about transparency. As of, well, mid-October 2025, there's no verifiable SEC 10K or 10Q publicly available.
No current official filings.
Correct. No recent 10K annual report or 10Q quarterly report filed with the SEC that we can independently verify. And that lack of current public financial filings, it severely limits transparency.
Okay, hold on. Lots of early-stage companies are cash negative, maybe file a bit late.
Right.
Why is this lack of a current K or Q worse than just knowing they're losing money?
Because it's the difference between verified losses and unverifiable solvency. Without those key audited filings, we just can't confirm the basics. How much debt do they actually have right now? What's their liquidity situation? Cash reserves? Actual free cash flow burn rate?
We're relying on press releases and analysis, not the official stamped documents.
Exactly. We're relying on management's narrative, on third-party estimates, not independently verified data from the company itself filed with regulators. So the risk level is just fundamentally higher right now. Any investment today is really a calculated bet on that narrative until those audited reports surface.
So the positive strategic shift is great news.
Overwhelmingly positive, yes. But this lack of financial clarity raises a critical question for investors. We need the upcoming earnings report to shed light on solvency. We need proof that management's shift towards capital discipline came from internal strength, like improving operations, not just because they were running out of cash or options.
That's a really important distinction, strength versus necessity. Okay, so high potential assets, a win on the capital strategy front, but this major data gap. Now, let's pivot again, because despite that data gap, the price action tells a different story. Here's where it gets really interesting. Let's look at the technicals and what's coming up. The momentum seems incredibly strong.
It really does. Suggests significant speculative belief in that narrative we just discussed.
Yeah, the stocks recovered impressively from lows earlier this year, like 0.32 cents. That shows strong accumulation, persistent interest through 2025. Sure, it's volatile, traded between $3.20 and $4.71 recently, which is expected for this kind of stock. But the technical setup looks, well, very bullish.
Trading above key moving averages.
Significantly above both the 50-day and the 200-day moving averages. That confirms strong bullish momentum is in play. The recent range looks bullish too. Analysts see potential up to $6.20 if catalysts hit. And interestingly, the beta is 0.93. Pretty moderate correlation to the overall market.
Meaning its run has been mostly company-specific news driven?
Seems that way. Driven by that strategic pivot we talked about, rather than just riding a market wave.
So the technicals confirm the market believes the story, or at least is betting heavily on it. But the calendar, that's full of potential make-or-break events, things that will either validate this or potentially puncture the balloon.
Exactly. The next few months are absolutely loaded with catalysts. The single biggest one is the Q3 2025 earnings announcement. Now, we saw conflicting dates in sources. Some say October 30th, others say November 14th. Either way, that late October, mid-November window is critical. What are we looking for specifically in that report?
We need to see real, tangible progress on the Texas digital project. And crucially, concrete guidance on future revenue. Something that starts to justify this $129 million market cap.
Makes sense. Proof of execution.
Beyond earnings, we're looking for signs of institutional buy-in. Is the big money coming in? There's a major ETF rebalancing around November 15th, and then the institutional 13F filings are due December 12th.
The 13Fs will show who bought, sold, or held in the previous quarter.
Right. They'll reveal if pension funds, mutual funds, the large players are finally taking positions or increasing them. That institutional validation could really add fuel to the fire.
Any other operational updates to watch? Yeah, there's mention of a holiday operations report around November 25th. Might give some early insight into capacity utilization or milestones for the Texas build-out.
Okay, and we should probably touch on the rumors too, right? Because let's be honest, speculation fuels a lot of these moves. We have to stress these are unconfirmed.
Absolutely. Purely rumors at this stage, but they represent potential high-impact upside.
Well, there's talk of a potential strategic partnership with the top 3 U.S. hyperscale cloud provider.
That would be enormous. A huge validation, guaranteed revenue stream if true.
Massive.
Yeah.
Then there's chatter about an AI edge computing product launch, maybe before year-end, tapping directly into that AI frenzy.
And M&A whispers.
Yeah, persistent rumors of interest from major energy companies. The big players looking to buy their way into digital infrastructure exposure. Any confirmed deal there would likely mean immediate substantial gains for shareholders.
Okay, so let's try and tie this all together. It's a complex picture. We've got this aggressive, seemingly confident management team. They removed the biggest overhang, that threat of massive dilution. They're backed by potentially valuable helium resources, providing some diversification, and the technical momentum is undeniably strong.
But it's all built on what seems like an opaque foundation right now because that verifiable recent financial data just isn't public yet.
So what does this all mean for you, the listener, trying to decide about NUAI?
Well, the sources we looked at seem to converge on a outlook that's, let's say, cautiously optimistic, maybe excitedly cautious. The final verdict came in with an overall bullish rating of 8 out of 10.
An 8 out of 10. That's pretty strong given the caveats. What's the rationale?
It's sort of twofold. Short term, it looks attractive purely for speculative trading based on that Q4 catalyst pipeline we just laid out, earnings, institutional filings, potential rumors becoming real. And then longer term, it's seen as a compelling speculative hold because of the helium optionality and the broader tailwinds in digital energy infrastructure.
But that risk?
The risk is high, no question. The caveat is crystal clear. This is a trade or an investment strictly for risk-tolerant individuals. People who understand the current valuation is driven by narrative and technicals, not by a currently verified, strong balance sheet.
Okay, so to really feel confident in that 8-10 bullish rating, what's the one key thing you, our listener, absolutely must monitor?
It really boils down to that upcoming Q3 earnings report. Whether it lands October 30th or November 14th, doesn't matter. Does that report provide verifiable proof? Proof of improving cash flows, even if still negative. Proof of successful execution on the Texas Digital project. We need evidence that management's capital discipline shift, that big U-turn, was genuinely based on improving internal strength and operational success. That's the critical piece of information. That's what potentially turns the current speculation into a more calculated, informed bet.